And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, my God. Are you nuts?
With your host, Phil Grande.
Bye.
I think all the fundamentals we see, we just wrapped earnings season, looks pretty good. And
Looks pretty good. Earnings season. I mean, it's unbelievable. These jibber jabbers don't understand how the market works. You know, everybody looks at earnings. Yeah, sure, they're important, but what drives earnings? What really hurts earnings, or what helps earnings? Remember, everything is driven by our rates. The 2-year is the most important one, 2-year Treasury. That's the most important. And of course, the 10-year. So, and remember the 10-year, everybody thinks the 10-year rate only has to do with mortgage rates. Well, it's not true. It has to do with valuations too. That 10-year mortgage, they go out and they'll put valuations, or talk about valuations. And when they say valuations are too high, look what happened yesterday. Yesterday was interesting. North Korea, their regulator comes out and says, wow, valuations are really high. And then everybody panicked and sold everything off, the tech sector. Well, that was pretty dumb, because that was no surprise. We have known for the last 2 years that 12 tech stocks been driving this whole stock market. 12 stocks, tech stocks are holding up 700 stocks that are traded every day. Not the 5,000. Let's take the 5,000 and break it down to the 700 they trade every day. In other words, take your S&P 500, add to it the NASDAQ, and IWM, small mid-cap stocks. So it's about 700 stocks. 12 stocks. And it's always the same thing. Cut rates, right? But here's what happened. When they turned around yesterday and they said that we got a problem here, the valuations are too high, and when everybody started to sell off, the computers kicked in. Because we don't have in place anymore our institutions. Think of the institutions. They have a pool of money of about $50 trillion. At any one given time, out of that 50 trillion, they put in the market about 12 trillion, which they use to trade. Think of a big pool or a lake with 50 trillion. They take, say, 12 trillion and think of a lake, and all of a sudden there's these pipes that are going out of the lake. And the pipe will go to tech stocks, the pipe will go to healthcare stocks, home builder stocks. And you got to keep pushing that money through this pipeline to get to those stocks. But the minute you got rates going up, that pipeline gets cut off. And what cuts that pipeline off, or these rates keep going up, is our deficits. Our deficits are killing, every day, like today. Do you know today they're going to be in Washington? They're scrambling around to cover $5 billion. That's right. They're short. $5 billion, the Treasury Department. They can't pay their bills. So they got to cover that $5 billion. So they do it with short-term bonds, right? They sell bonds, short-term, but they do it with the 2-year. And the 2-year is the most important Treasury ever, because, as I told you before many times, that 2-year affects everything. Affects your credit cards, your auto loans, your personal loans, your small business loans, credit lines of credit at your business. I could go on all day what it covers. That 2-year Treasury is so important, and you've got to keep that 2-year Treasury yield around 3.5%. Today we're at 4.1%. if I'm correct. And when that 2-year treasury goes up like that, that's a killer. Everything gets expensive. And people want to know, why did the market go down yesterday? Oh, the valuations. No, the market went down yesterday because money's too expensive. And that's why I saw this article today that Willie gave me about how mortgage rates, okay, the housing business is in real trouble because the mortgage rates are too high. Well, that goes back to, again, spending, budget deficits. Every time you run a budget deficit and every day you're short $5 billion, the geniuses in Washington, the Treasury, they sell these 2-year treasuries they try to sell it to banks. Banks don't want them anymore. The biggest purchaser is, of course, foreigners. They don't want them anymore. But that's what they try to do. And just know that every time that 2-year yield keeps going up because of the deficits, they won't cut spending, then everything goes up. Your credit card interest rates goes up. Everything goes up. So, but I want to get back to my subject here, what I started out with, is that we had a blowout yesterday, and then what happened today, the yield started to drop a little bit. The 10-year dropped a little bit. The 2-year dropped a little bit. So what's happening right now is you have your mega caps, your big tech mega caps, just like your Magnificent Seven, your big boys. You have the stocks that carry this whole market, ASML, LRCX, AMET, and CLAC. They're the companies that make the machines, that make the chips. And then you have another group, the buyers, who are the machine, who goes and buy these machines, like Intel, MU, AMD. And then you have all the infrastructure stocks, and that's like the plumbing with all the AI and everything. That's like Qualcomm and so forth. And those stocks, if you take that's the whole AI world right there. Okay, that's the AI world. The mega caps, you always think of them as Magnificent Seven. There's more mega caps than those, but let's just say the mega caps. And these 4 companies that make the chip machine, and then the people who buy the chip machine, Micron, Intel, so forth. And then the other sector, of course, is the infrastructure, okay, stocks, like your plumbing of AI and all that. They're all in deep trouble right now because what happened, the market didn't drop yesterday because they all of a sudden, one hung low from Korea, all of a sudden decided, a regulator, to tell the traders in Korea that the valuations are insane. Well, our regulators know that too. But remember, the difference is our regulators don't work for us. Our regulators work for Wall Street, the brokerage houses. So that's why you don't hear our regulators come out and scream valuations are too high, because the regulators don't work for us, because they get paid by the big brokerage houses. All these big brokerage houses have to pay fees every year, and those fees go to supporting the regulators. So the regulators won't say anything. But this guy in Korea did. But it was no big story because we knew anyways, going on for 2 years, the 12 stocks are holding up the whole market, like I said a minute ago. Now, the story comes out today. Okay, so here we are. We had this big blow off yesterday. We went down almost 1,000 points, but it came right back, clawed itself back. We're only down about 400 points. Because why? Because remember what happens. The big institutions that have the $50 trillion normally have in them that 50 trillion use 10 or say 12 trillion to trade stocks. They pulled that money out, and there's only about 1 trillion to 2 trillion in the market. So what happens is the computers kick in. So yesterday, when the guy made that announcement, the Korean stock started to drop. Instead of our institutions kicking in and selling stocks short And when the market went down, if the institutions were participating, which they're not anymore, well, once the stock went down 900 points, we'll say, we're down 900, they will support that short position. The computers are programmed not to support the position. The minute the last ticket is gone, the last sale ticket's gone, the computer kicks in and goes the other way and starts buying. So you have this huge trap that will continue. You got to know what you're doing, because same going the other way. If the stock market goes up 1,000 points, God, I think I'm going to add another 500 shares, but you get caught in the trap, because if it was the institutions with, it used to be 12 trillion that was in the market, now it's been reduced to about 2 trillion, they would support that position, but they're not in the market anymore, okay? So now they turn around and the computer will turn around and all of a sudden you went up 1,000, it comes right back down 1,000 points. So that's what's going on. That's one of the biggest problems. That's why we're getting caught in these traps. Market's going down, you get caught, it goes back up, market goes up, it turns around, goes down, because it's all bots, B-O-T-S, bots, computer trading, okay? But going back to the real reason that your stocks dropped is because the money's too expensive. So today, for example, if you take the mega caps, you take the big chip machine producers, those 4 companies that hold the whole market up, and you take the companies like MU, AMD, all those companies who buy the machines, and then you take the companies who do the plumbing, that's AVGO and Qualcomm, and then they went up a little bit today because the yields came down a little bit, right? But there's nothing there to support it. So everybody's saying, well, wait, maybe I think I'll go in and buy again now that we're going back up. Well, remember, there's nothing supporting that market. And with that Treasury yield where it is right now, the rate that it's at, it's so high, so far away from where it should be at 3.5 that this market is really getting dangerous, because all this tech stocks, the 12 tech stocks hold the whole market up. Now that everybody's finally admitting the money's too expensive, it's going to kill these tech companies. All these data centers that they build out, they have to borrow money. They got to get that 2.4, and they got to get that 2-year yield. What's it now? 4 point. Anyways, let's say I'll guess that at 4.19. Yeah, 4.19. 4.14. We got to get it down to 3.5. If you put that on a scale of 1 to 10, how difficult it is, it's a 10. Do you know how difficult that's going to be? So we got a big problem there. That's one big problem we got, the text. That's going to blow up at some point. And the big lesson, always remember this. Always follow the 2-year Treasury, because the 2-year Treasury, if that yield goes lower, okay, I'm sorry, the 3-year Treasury, follow the 3-year Treasury. If that 3-year Treasury, remember, if that goes lower than the 2-year, you definitely have a crash. It never fails. Let me repeat. Always watch your 3-year Treasury. When that rate goes below the 2-year, which is the most important yield in the country, if it goes below that, you're gonna have a crash. So we got that problem. Now let's go to the other big problem we got. The housing market. That's our big problem, because that's the economy. First-time homes, that's the economy. Someone gets out of college, they get a job, they go buy a home, they get married, they have to buy furniture. That always has built the country. Weddings have built the country. When you get married, you need a house. People can't get a first-time home anymore. Why? Look what they just said today. New home sales dropped down 7%. The lowest since January. That's 2 months in a row. Why? Because the mortgage rates are too high. Why? And I'm going to take a little extra time and explain this to you. I don't want to leave you with this. This is too important. Because nobody's going to tell you the truth. So the mortgage rates are too high. And because when mortgage rates explode, it's because the 10-year Treasury explodes. Now, that's the mortgage rate. So, but the other side is that 2-year Treasury, that makes everything that goes into a house more expensive when that 2-year Treasury rises. You got to keep that 2-year Treasury near that 3.5. And you got to keep that 10-year Treasury yield. You want to get that yield way down. But we can never get it there because they're spending $5 billion more a day, the geniuses in Washington, than they're taking in. So the biggest problem we have is our whole stock market is based on 11 stocks or 12 stocks. And our other side of the economy is all based on housing. That's all we do is housing. So the 2-year, if you watch that, and that thing keeps climbing, that's going to blow up the housing market. And it's going to blow up the stock market. That's why you always see them go at the same time. So we're in a dangerous area right now. So the Fed, here's what happened with your mortgages and why they're so high and why nobody can build homes for young couples who just got married. I mean, that's what our country used to be. That's what builds a country. When people get married and have kids and they got to buy a lawnmower, they got to buy this, they got to buy furniture, they got no more. People that are 30, 40 years old are still living with their parents, for God's sakes. Look at that idiot who's running in Texas, the communist down there. I can't think of his name. He keeps his checking account with his mommy. Now, I won't get into politics. So the mortgage rates, again, exploded because the Fed kept those rates too high for too long. Because they said, well, we'll keep fighting inflation. Got to keep fighting inflation. Give me a break. Fight inflation. They never fight inflation because they keep spending. So the government keeps flooding the market with bonds. Hey, we got to borrow more money. We got to borrow more money. So they keep flooding the market, okay, with bonds. Hey, take our bonds. We want to borrow money from you. Here, take the 2-year bond, 2-year bond. And then the yields go up, the yields go up, the yields go up. The 10-year yield goes up, the 2-year yield goes up. And you wonder why you can't buy your first house? And that was all caused by, again, how much money, remember how much money Biden was spending and his team? And remember, inflation went to 9%? So when rates jump, housing always is the first thing to break. And where we are right now, the big picture, when housing rolls over, and it's going to, the rest of the economy follows within 6 to 9 months. But we got a double whammy. Nobody in Washington is going to tell you. Nobody on Wall Street is going to tell you. While this is happening, and it's going to happen, you got the stock market on the other side that's going to roll over. Because why? Because you only have 12 stocks that are holding up 700 stocks. And the big problem is everything's AI, right? And now that the 2-year yield is so high, the 2-year Treasury so high, that the cost for AI to borrow money has gotten way too high. So people are starting to rotate out of the tech stocks, and they're going into leisure stocks. Now, we've been in leisure stocks. We probably started buying our leisure stocks, maybe, I don't know, 2 months ago, a month ago. But everybody now is jumping into leisure stocks. They're getting out of tech stocks, going into leisure. There's no place to hide when this occurs. The only thing you can do to make money is short. You got to know how to short. But the point I'm making is the reason we got screwed is because the Fed kept rates too high for too long. Say, oh, we got to keep fighting inflation. Well, you wouldn't have to fight inflation, going back to Biden, both Democrats, nobody gets out of this. Both Democrats and Republican caused that money to go up to 9. I mean, are you kidding me? 9% inflation. So that when that inflation it kept going up and up and up, they had to keep borrowing more and more money because inflation's going up. You got to borrow more money, and then the Fed rate kept going up. I mean, the 2-year going up, and then the 10-year starts going up. Your mortgage rates start going up. It all comes back to Washington spending more than they're taking in. And now they're getting caught in 2 areas. Watch that 2-year Treasury. The higher that goes, it's going to blow up the mortgage business, the housing business. It's going to blow up tech stocks. So you're going to get a double whack right there. You know how much money the government borrows? They borrow a ton of money, record deficits. I mean, when the government keeps flooding the economy with more treasuries, because they got to sell treasuries to borrow money, right? That will keep pushing these yields up higher and higher. Now, foreign buyers said, screw you. Japan used to buy them. China used to buy them. Okay? All over the country, all over the world, they buy our treasuries. No, they're not. They stepped away. Now we got a bigger problem. Now I want you to play the cut when we entered the show today. Play the cut, what she said, how everything's wonderful.
I think all the fundamentals we've seen, we just wrapped earnings season, it looks pretty good.
What does she know? What does she know? She knows nothing about this stuff. Oh, it looks pretty good. Oh, it looks pretty good. It looks pretty good when the 2-year Treasury is going up to 4.19 when it should be at 3.5. Are you kidding? And mortgage rates have gone right up because of the same reason, because of deficits. So again, the 10-year went from 1.5%, remember, to 3%, to 4%, to 5% in a few years. Couldn't anybody in Washington look at it and say, wait, this is nuts? What are you, nuts? We're going to kill the first-time home buyer. It's the first-time home buyer, the young kids, to buy a home. That's our country. That's what builds our country. They got to buy stuff. They got to buy stuff. So the 10-year yield at 2% to 3%. So when that 10-year yield then got up to 4.8%, 5%, mortgage rates went from 2%, 3% to 7 to 8%. That's the whole deal right there. And then this week, the tech stocks collapsed, not because of some Korean one hung low up there. So, oh, valuation's too high. No. Nobody got the story right. It's because the Treasury yield went up too high. Why? Because we didn't raise rates. We kept rates too low for too long. So that's where we stand right now. So here's what you should do. And we're doing this too. We're going to watch the builders. So we're going to watch the 2-year. Always watch that 2-year. It's the most important one to watch. Watch that 2-year. And for the builder side, so watch the 2-year for everything, especially for the stock market, because that will tell you when the stock market's going to crash. It's never wrong. And the 3-year, if it goes below the 2-year, you know it's 100% the market's going to crash. But the other thing you got to start watching, so the other side of this thing with the house, remember 2 things, stock market, homes. Stock market, homes. We're in the middle. Okay, and they got the artillery on both sides. We're right smack in the valley. They're going to land all that stuff on us. So we got to sit there and watch D.R. Horton. Watch these home builders. And try to get the information on their cancellations. I used to do better than that. I used to go around, send somebody around and talk to the people at these home centers. You know how on the weekend everybody runs around every weekend, every Sunday, right? Going to all these home centers, right? Most of them go there just to get decorating ideas. Well, you're nuts. But anyways, But I could always figure out when I sent people out, they would talk to the salespeople. Well, how's your traffic? How's your traffic? And all of a sudden they start telling you, oh, traffic's terrible, traffic's terrible. Or we got a lot of traffic, but we're not signing anybody. We're not signing anybody. But the real thing you want to know, you ask them, how many contracts are getting canceled? How many contracts? That's the information you want to know. How many contracts are getting canceled? And they'll talk, oh, these salespeople, okay, at these sales centers, these home sales centers, I mean, they love to talk. And she said, yeah, how's cancellations going? Oh my God, it's brutal. Last month we had 30 signups and 15 canceled. That's the number you want right there. Now that's what Wall Street does, but they won't give it to you. If you're in a mutual fund or you're in a 401k, you don't get any information like that. You got to have $5 million with Goldman Sachs or Wells Fargo or Morgan Stanley or Citi to get information like that. You can get it from us. You got to be a member, though. So that's what's going on. I don't want to take any more of your time. So prices are just way too high with these houses. These houses are so stupid. The price of these houses, I can't believe what they're getting for $500,000. $500,000. We were buying those houses, 12 years ago for half that? I mean, houses have gone 50, 60% in 6 years. In 6 years, are you nuts? Wages didn't go. Oh, you heard our fundamentals, right? Oh, fundamentals are really great. Oh, earnings are good. Fundamentals. Oh, wages are increasing. No, wages aren't increasing. People are getting screwed. A couple that makes $65,000, $75,000, $85,000. Are you kidding me? They're underwater big. So if housing, the price of a house is going up 50, 60% in 5 years, and a kid just gets out of college, he gets married, he wants kids, he wants to buy, you can't. So mortgage rates have doubled. They've gone from 3% to 7%. What are you, nuts? Down payments? Oh my God, down payments. You better have a rich uncle. They're impossible. A starter home used to be around $150,000, $150,000. That same size home, that's $150,000, the starter home now, depending where you live, let's say Sarasota, Florida, is about $500,000, $600,000. Yeah, a house that used to pay $150,000, $175,000 for a starter home, it was about 1,200 square feet. Right now, that same home is $400,000 to $500,000. Isn't that nuts? You got to put a payment down of 20%. Even if it's 10%, some deals are 10%. And you don't want to buy a house where they, oh, well, don't worry, we can get you in for 1% or 2%. That doesn't help you, because when the market starts dropping, you're upside down in your house. Just like with your car loans. Now they got car loans out for 10 years or whatever they are. Everybody's upside down with their car loans. So let me finish with this. My message today is nobody's telling you the truth. The truth is we have lost 2 battles. We're finally losing the tech battle. That will be over, okay? Now, when you see the 3-year Treasury go below the 2-year, that's when you know that. And everything's going to blow up. Keep your eye on that 2-year Treasury. The next thing is that the mortgages, okay, right now, and people are in default. We've never seen so many defaults. They're hiding them. The banks are hiding them. They're not even recording them. Do you know that? And then you got the student loans. They're choking everybody. So I can go on all day. So again, if you know how to sell stock short, we're more than happy to show you. That's your best defense. And for those people who are taught cost average down when the stock market goes down, your stock starts, keep cost averaging down. Didn't you learn your lesson in cost averaging down with Enron? You never cost average down in a downtrend unless there's QE. If the government puts in QE again, then in a downtrend, if your stock's going down, you can buy that stock because QE's a guarantee they're going to push it back up. But in a downtrend, Wall Street has been poisoning everybody. It's taking parking space that everybody had. Don't short, don't short, don't short. Of course they don't want you shorting because they need you to be scared to death that you won't short, that you'll cost average down, and you'll buy on all these dips in a downtrend to hold the price of that stock up so they can get the steel workers, the teachers union, the automobile union, get those people out of the stock or out of the market. All right, I'm going too long today. So, all right, so I just tried to tell you the truth. I'll see you on the charts.